I don't think this is not the beginning of the end. It might be the end of the beginning, but we think this was just the initial battle. We think there's a lot more battles to come.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
What's up, guys? Jay Martin here, CEO of Cambridge House. And today, in response to many, many requests that I've received in the comments of previous YouTube videos, I'm sitting down with Brent Johnson, manager of Santiago Capital and the originator of the dollar milkshake theory. And today we talked about everything from Brent's outlook on US dollars, which obviously is bullish. However, I pressed him to elaborate on how he sees that game ending and what signs he's going to be looking for globally to know that the US dollar surge is coming to an end. I got him to open up about his portfolio and talk about where he's allocating capital, precious metals, gold, equities, cash, etc. I got his opinion on cryptocurrencies and his forecast on the Bitcoin price and everything in between. It was a ton of fun to host this conversation. I hope you enjoy it. And if you do, please click subscribe. And then in the comments, let me know who you want to hear from next, and I will go get them. Okay, thanks so much, guys, and enjoy. Now let's go back to March a little bit. How quickly were you on top of COVID and this pandemic becoming as big of a threat as it's become?
Well, the interesting thing is, the thesis that we have on the dollar going stronger, this has been developed over several years. And it actually started in 2016, which is part of the reason I didn't think gold would break out in 2016. But it's been developing and developing. And as of last summer, for several reasons, we knew that the table was set for a dramatically surging dollar. And any number of things could knock the table and have the dollar start to run. The last thing in the world I ever would have thought that would do it was a virus, or a global pandemic. And I will be honest, I think it just literally started to break when that weekend that the conference was in Vancouver. Because I remember talking to a few people about it or hearing about it. And I, to be honest, I didn't think too much about it at first. Once we got into early February, then I started thinking, you know what? I don't think it's that big a deal, but I know that everybody else is going to think it's a big deal. Mm-hmm. And so we started putting but we already had our positions on to benefit from this. Again, I had no idea a virus would be what caused it.
Right.
But once we realized that it was going to be a big deal, and not just from the health perspective, but the locking down of economies, because that just takes the velocity of money to zero. The velocity of money was already at an all-time low, and then you shut down economies. We knew once it started to develop, we knew that it could take a header very fast. And so, we had in my separately managed account business, we had a number of put options on our equities, which really helped us. Didn't help us perfectly, but helped us. In our private fund that we manage that's focused on the dollar, we already had a lot of positions that would benefit should that happen, and we added to those. And so, so we had a couple of pretty good months. Right. Now, in the last 6 weeks or 8 weeks since kind of the height of the crisis, those positions have pulled back because the dollar's pulled back. The central banks came out and printed a lot of money, made a lot of promises, made a lot of guarantees. We don't think this is over by any means. I get a lot of questions. I get a lot of emails, a lot of things on Twitter, how much longer can this go on? And the answer is that, I don't think this is not the beginning of the end. I've said this many times. I steal this line from Churchill. It might be the end of the beginning, but we think this was just the initial battle. We think there's a lot more battles to come. We don't think it's going to be easy. We do think that the monetary authorities will try to keep the dollar from going much higher. We think that they have a limited capacity to do so. Mm-hmm. And so while they'll get it under control for a little bit, but then something else will happen. The dollar will run higher, and then they'll do something new and it'll pull back a little bit. But we think it'll be a cascading crisis higher over the next couple of years where the dollar gets extremely strong and markets around the world, remain under extreme pressure.
So what about just in the next year? I mean, yeah, in March we saw the liquidity crisis and
Yeah.
dollar surged. Every asset class in the world was being sold, and this flight to
Yeah.
USD. And then probably as you expected, the stimulus was super aggressive and has
Yeah.
essentially fueled the hopes and dreams of the market,
Yeah.
like everything's back to normal, but it's not, right? The economy
Yeah.
is at a standstill.
Yeah.
Companies are going bankrupt and will continue to go bankrupt left, right, and center. What's next? There's a pretty significant insolvency crisis right around the corner, no?
Yeah. So first of all, I'll say that, I was, I, people in my business are never happy, but I thought we did pretty good job through the downturn, as far as, the U.S. equity markets falling. One of the most controversial parts of my whole dollar milkshake theory is that I think over the next 2 or 3 years, U.S. equities will rise and go back to their all-time highs and then
Right.
go even higher.
Heard you say that. Yeah.
And so, but I'd also been saying that I thought we'd probably get a pull down or a pullback before that happened. Well, we got the pullback and then some, and it pulled back even farther than I thought. But did a pretty good job of removing our hedges, and we actually bought some calls, maybe not the day of the low, but pretty close to the day of the low. And so when that big rebound came, I just thought, wow, you really played this well, Brent. Good job. But I sold those calls like 2 or 3 days after I bought them. The market was already up 10 or 15% from the bottom. And I thought, wow, that's a great trade.
Okay.
But, here the market's gone another 15% since then. Right. And then, so I was expecting a big rally. About a couple of weeks ago, I put a collar back on our equity portfolios. A collar is a way you can sell away the upside and buy protection on the downside. Because I think that it's most likely between now and the election, we'll get some further equity weakness. I don't know if we'll go all the way back down to the bottom. Wouldn't surprise me. But the market ran 5 or 6% higher since I put that hedge on. And so I was joking with somebody today. I said the milkshake's playing out without me, and I'm hedged. So it just goes as the reason I bring this up is for even those of us who believe in my theory and who thinks it's going to play out, it's still somewhat hard to believe. And I think that's largely how the next couple of years are going to be. I think things are going to happen that just don't make a lot of sense. And even if you're ready for them, I think they're going to be somewhat hard to believe.
What's the main opposition, Brent, that you hear when people disagree with the milkshake theory and the rising US dollar?
I think there's 2 things. One, the first thing is that people just don't believe the dollar will rise to begin with. So the first argument is that the Federal Reserve is going to print so many dollars that the dollar is going to get inflated away. It's going to go to 90 to 80 to 70. This is kind of the heart of the bet I have with Peter Schiff, whether the dollar goes up or down, and whether gold will go up or down.
Fiat currency is going to perform the best.
Well, I don't know. I think the dollar, though, is going to do worse than the other major fiat currencies over time. Well, because I think this whole fiat system that we have is nearing the end of its life, and the fact that we're at, these 0% rates or negative rates and all this stuff that's going on is the death knells of this system, which was doomed from the start.
If the rest of the world defaults on their $13 trillion, $14 trillion in U.S. debts, is that a benefit to them? Or is
They're not going to have to default. They'll be able to pay it off.
With what?
Because the dollar's going to crash. That'll be like monopoly money.
I mean, listen, at the end of the day, I agree with everything Peter is saying regarding the U.S. It's a disaster, and it's going to end really, really bad. I just think Peter has it completely backwards. Is the dollar index higher or lower 18 months from now?
I think it's going down.
What about? I'll bet you a gold coin.
Let's do this. A gold coin at this conference, DXY, higher or lower from this point in 2021?
All right, I'll go double or nothing.
Playing with house money. Why wouldn't you?
And that's a gentleman. A gentleman always lets to go double or nothing. What's that?
I said he's playing with house money. Why wouldn't he take the bet?
Well,
because he doesn't want to lose his only gold coin.
I just said I would bet if you wanted me.
Okay, so we got the bet. Yes or no?
Yeah, sure.
So the DXY. So everybody on YouTube world here, the bet is at the 2021 conference, the DXY is higher than today, which is the close of, what's it today, January 20th?
What is it? It's like
I'd prefer 18 months, but I'll go 12.
Like
12 months. You're a good sport.
And so I think that's the number one argument, is that, first of all, you've got the whole dollar thing wrong. There's no way the dollar's going higher because they can't let it go higher, and they'll do everything they can to stop it. Okay, I agree with it that they don't want the dollar to go higher, but I do think it's going to go higher. But then the next biggest thing that comes back that says, well, if the U.S. dollar goes higher, that will be very bad for U.S. equities. There's a lot of people who can get on board with the dollar getting stronger because of a deflationary event, but then they think that's really bad for U.S. stocks. And in general, I don't disagree too strongly with that in the short term, but what I think happens is that we get into this global crisis where money around the world has to go somewhere. And I think as money starts to leave other markets around the world, it's going to look for which market has the most potential, even if it's not great potential, which place has the most potential, which has the most liquidity. And I think that's the U.S. equity market. I think one thing that a lot of people forget, and I think this happens to individuals maybe more than institutions or people who work in finance in an institutional capacity, is that as an individual, you can just sell everything and go to cash. You don't have to buy Amazon. You don't have to buy Apple. You don't have to buy, these FANG stocks or these high, the energy stocks that are the shale. You don't have to buy them. You can just go sit in cash. Big institutional money can't just sell everything and go to cash. If you're running a big mutual fund, you have to put your money somewhere. Maybe you can have 5% cash, but you can't have 50% cash. If you're running an endowment that's got billions of dollars, you can't go to cash. If you're running a pension fund, you can't go to cash. You've got to allocate your assets somewhere. So it's not a question of it's not a question of whether or not you're going to invest. It's a matter of where you invest. And the other thing to remember is that, currencies especially, they all trade relative to each other. So even if you think they're all crap, one of them is going to do better than all the others. And that's kind of how I am with the dollar. I agree that all fiat currencies are junk. They're horrible. They've got all kinds of flaws. They will lose intrinsic value over time. But one of them is going to outperform all the others. And for several reasons, I think that's the US dollar. And so when you look at things like the dollar index, that's why the dollar index can go up, but also gold can be going up, because gold can be rising versus all fiat currencies. And then the dollar can be rising versus all fiat currencies as well.
Sure. Yeah.
And so I think, but the U.S. equities rising is the biggest pushback I get, because they'll say, we've got this high unemployment now, we've got the valuations are through the roof. There's no way the earnings are going to hold. And I don't really argue too much with those points because they're valid. I don't think that equities are going to go up over the next couple of years because there's great value in them. I think they're going to go up because, it's one of the few places where people will seek shelter from the global currency storm, for lack of a better word.
Interesting. Okay. Yeah, it makes sense to me, Brent. Now, can we talk timeline a little bit when we're talking the US dollar, essentially in your view, relative to other currencies, will be the last man standing, right?
Right.
But when does that game start to complete?
I think here's the other interesting thing. I find this interesting is that in many ways it's already playing out in spades. And what I mean by that is if you look at the dollar versus the euro and the dollar versus the yen, they're basically flat over the last couple of years. The yen's up a little bit, the euro's down a little bit, but for the most part, they're just kind of range bound. And those are the two biggest components for the DXY, which is the dollar index. And so when you look at it, the dollar really hasn't done anything for a couple of years. But if you look at the dollar versus emerging market currencies and a number of other global currencies, if you look at the broad trade weighted dollar index, if you look at the Asian dollar index, the dollar is crushing the rest of the world. There are several currencies, especially in the emerging markets, that are down anywhere from 5 to 25%, just in the last year versus the dollar. The Asian dollar index is breaking down from a multi-year pattern. The broad dollar index, with it's got a cup and handle that's now broken out, and it looks like it could run significantly higher. So this is already playing out. I think when people think of the dollar, they think of the dollar index. It's basically the euro and the yen. Those will probably be the last currencies to fall, not the first currencies to fall.
It's the euro and the yen.
Yeah. The Brazilian real has just gotten killed. The Turkish lira has just gotten killed. The Australian dollar has had it's down 10% from, a year ago, but it was down 15% at one point and has rallied a lot in the last couple months, but we think it's going to go much, much lower. You know, the Indian rupee is down versus the dollar. I can go through all this list of currencies where it's just the Mexican peso is getting killed. It's just one after another, and this is causing real problems for the rest of the world. And this is part of the reason why the markets sold off so much and there was such volatility in March was it's basically a global call on the dollar. They just needed dollars under all circumstances. It didn't matter the valuation. It didn't matter the price. Just get me out and get me cash. And that cash needs to be in dollars because the dollar requirements of the global monetary system. And you know this because everything fell. Stocks fell, bonds fell, gold fell, commodities fell. It didn't matter the asset class. The only thing that mattered was dollars. And so, the thing that I think a lot of people forget when thinking about currencies, especially I'm going to pick on the precious metals world here a little bit. And first of all, I have a lot of friends in the precious metal world, so I say this with great affection. I think the biggest mistake that people in the precious metals world make is that they focus on dollar supply. You know, the Fed's going to come in, they're going to increase supply. There's no limit to the amount of dollars we can print. The more you make of something, the less value each individual unit have. Totally makes sense. But what I think they do is they focus too much on the supply and they forget to focus on the demand. The demand for the dollar is incredibly high. You know, the dollar money supply in the United States, that's mainly for the United States, but the dollar money supply in the dollar system outside the United States, in other words, there's dollars that sit inside the United States, and those are called dollars. There's also dollars that sit outside the United States, and those are called euro dollars. It's not euros, it's euro dollars, and there's a difference. Euro dollars are just dollars that are outside the United States system. Well, that market is almost as big, and in some cases bigger than the U.S. domestic market. The problem is that the Fed doesn't have jurisdiction over euro dollars that sit in Europe or Romania or India or Turkey or Brazil or China. And so the way that the monetary system works is that money gets loaned into existence. It's like a margin account. You put some money in the account, you buy a bunch of stuff on margin. As long as the prices go up, there's no problem. But if the prices start to come down, you get a margin call. You have to put more money into the system. It's the same thing with the global monetary system. You've got the monetary base, that's the collateral off of which everything is loaned into existence. That's fine as long as everything's growing and circulating and there's velocity of money. But when the velocity of money stops and the value of all that stuff that's been loaned into existence comes down, you got to put new capital into the margin account. That's what the Fed does with QE. They put new money in to recollateralize the system. Well, when the same thing happens outside the United States in the euro dollar market, when a contraction comes and when those assets start to fall, there's a margin call. But there's nobody to input dollars because nobody has the authority to create dollars other than the Fed.
Right.
And so that's what we saw happening in February and March. And so you saw these other countries, they started to even sell their dollar reserves. They started to sell treasury bonds at the height of the crisis. And so then some people will say, see, the Fed's going to lose control. The Treasury can't issue all this debt. The foreigners are repudiating the dollar. They're selling their treasuries. Well, no, they're not selling their treasuries because they're repudiating the dollars. They're selling their treasuries because they need their dollars. They need dollars to continue to operate. So it's just, again, that's the demand side. There is an incredible demand for US dollars. Like it or not, it is what makes the world go round right now. Now, in the future, it might be different. In the future, there may be a new currency. There may be a new currency system. Maybe gold will be part of it. But right now, the only game in town is the dollar.
Yeah, I mean, that's the only answer a lot of these countries would have is to sell anything that's not bolted down.
Right.
But what about in the event that we start to see, massive insolvencies and defaults on this US dollar demand? Yeah.
Well, so this is, I think, another mistake that a lot of people make, and not necessarily a mistake. They are correct. So if you borrow in dollars, that's demand. You have to pay that back. So that's demand for dollars. If you default on it, that loan disappears and that demand disappears as well. So that is correct. If there was mass defaults on dollars debt, then the demand for dollars would go down. But What people forget is that because money is loaned into existence, one man's loan is another man's asset. And in many ways, credit and loans and money are the same thing, or it kind of somewhat interchangeable in this monetary monstrosity that we've built. And so when loans start defaulting, that's fine, demand falls, but it cascades on the supply. So supply ends up, and that's a credit contraction. Supply ends up falling even faster than demand. So even if demand is falling, if supply is falling faster, which is what happens in a credit crunch, the price still goes up. So the underlying price, so we could have mass defaults around the world, either by choice or by just because they have no other choice. But that would be positive for the US dollar, not negative for the US dollar. What would be negative for the US dollar is if many different countries and entities around the world got together and said, we are going to default on the dollar in mass, and we are going to go use this other currency or this other system instead.
Right. If there was some collective agreement.
If there was some collective agreement to go do something else and to repudiate the dollar, again, in mass at the same time, and, and not doing business with the United States anymore because we're not going to do business in that other currency, then you could see the dollar fall dramatically. Because here's the other thing that people forget about when they talk about hyperinflation. Hyperinflation happens when there's no demand for your currency and people just lose faith in it, right? Sure. Well, let's take these smaller countries as an example. Argentina is a good example. They borrowed a lot of money in dollars. It seems like they default every 4 or 5 years. I don't think they've ever paid back a loan in history. But then and they don't have any dollar reserves, right? So what do they have to do? They have to print more Argentinian pesos to then go buy dollars, or they have to borrow in dollars. Well, there's not a whole lot of demand for Argentinian pesos inside of Argentina, let alone outside Argentina. Nobody in Korea needs Argentinian pesos. Nobody in Germany needs Argentinian pesos. Nobody in South Africa needs Argentinian pesos. But people all over the world need dollars. But when you get a currency that nobody needs it, you have to print more of it. And there's no confidence in because there's just no confidence in it. That's how hyperinflation happens. Yeah. So my opinion, we are going to see hyperinflation over the next couple of years, but you're going to see it in these smaller currencies long before you see it in dollars.
Okay. And so would a signal, I don't know if you'd call this the beginning of the end, but when, the yuan and the euro start to inflate, is that when we sort of enter the beginning of the end?
I think so. That's right. Yeah.
And can you speculate on what that end game looks like? Is this a US dollar crash? And then what? Or what does that look like?
I think what will happen is I think the dollar will get so strong that the world will come together and they will either write the dollar down in some form, forgive dollar debts, introduce a new currency, set up a new system. Maybe it's a Plaza Accord where they all agree that over the next 2 or 3 years, they want the dollar to go from 140 back to 100, or maybe they just cut it in half arbitrary. I don't know, but I think there will be some kind of a currency accord or some kind of a global effort, cooperation in order to devalue the dollar.
Okay.
Because the current monetary system was just not designed for the global reserve currency to be that strong. A strong dollar is bad for the global economy. And I'll touch on this because this is really important. There's this concept known as Triffin's dilemma, and it's based on an economist from back in the 60s. His name was Robert Triffin, and he basically said that if you have a situation where one country's currency is also used as the global reserve currency, at some point down the road, maybe not early on, but at some point down the road, the needs of the domestic economy are going to come into conflict with the needs of the global economy. Because for the global economy to run on dollars, we have to send dollars abroad. The way we send dollars abroad is that manufacturing takes place overseas. We send our dollars over there. They send us the goods. They pump the oil. We send our dollars for the oil. They send us the oil. We send them the dollars. That's how dollars get out. And that's the role of a global reserve currency. But when you get into a situation where the needs of the domestic economy come into conflict like that, and I'll give you a real world example, is that Donald Trump's Make America First policies. he doesn't want to send our dollars overseas and have everything manufactured in China. He wants to have it manufactured in Cleveland. He wants to have it manufactured in Mississippi. He wants to have it manufactured in Arizona. Well, if that happens, then the dollars are no longer flowing overseas. And then you get into that Triffin's dilemma. Now we're helping the domestic economy, but we're no longer helping the international economy. And so, and even if Trump does not get reelected, I think he will, but even if he doesn't, I think he has elevated the importance of returning U.S. manufacturing and the importance of not being reliant upon China for critical, national security concern items. He's raised it to a level to where I think even if the Democrats win, that new president won't be able to back up and go back to just outsourcing everything to China.
Right.
And so regardless of who wins the election, I think the heart of this Triffin's dilemma is going to play out over the next couple of years. And the monetary system is just not designed for Triffin's dilemma to happen.